What's up, guys? Welcome back to another video. My name is Nick. I talk all about trading and investing, and today we're talking about the carry trade. And if you're not familiar with the carry trade, it is a super interesting concept in currencies. It's actually one of the first concepts that I personally learned about when I first got introduced to Forex. If you're familiar with, or if you've been watching the channel for a while, you've probably heard that, I started out in stocks and I started out investing in stocks and eventually moved to trading them a little bit more actively. And then I eventually found FX. And one of the first things that I actually learned about was this concept here, the carry trade. Now, the carry trade is less popular today than it was back in the day, if you will. Back in, the 2000s to 2010, the carry trade was a very popular strategy that was relatively profitable if you knew how to do it. And in today's video, I'm going to talk to you guys about how I still think that there are some opportunities for the carry trade, even in today's world where interest rates have been cut like crazy, which is kind of some of the core principles behind the carry trade, which again, we'll get into that soon enough and we will talk about that. So don't worry if you're confused for starters. But basically, let's talk about the carry trade. What actually drives the currency market, right? When we're talking about the dollar or the euro or the yen, whatever we're talking about, let's just say the dollar, for example, what drives the US dollar valuation above or below other currencies, right? Or up or down against other currencies? Well, there's a lot of different factors. There's unemployment rate. There's like the confidence of the Fed and their ability to, kind of weigh the storm or ride the storm that we're going through economically, especially right now here in 2020. That is basically, it's a trust factor. Is the US dollar worth keeping money in, investing money in? And that really is a very, very important question. But one of the main factors, there's all different factors within it, but one of the main factors that impacts the carry trade is going to be interest rates, okay? And that is really what we are going to be talking about here with the carry trade. We're going to be talking about interest rates and why they matter for the carry trade. Now, the carry trade, to put it in as simple terms as I can, because it's a little bit confusing, it definitely was to me, but at first, but it makes sense now. After you practice a little bit with it, it'll make sense. Basically, the carry trade is the idea that because different currencies offer different interest rates, and these interest rates rise and fall with different market environments, but the general idea is that because some currencies offer more interest or less interest, there is a spread that can actually be capitalized on. So the simplest example I can give you guys is back in the 2000s, 2010s, a very popular trade was to basically trade the US dollar, Japanese yen, and to buy it, okay? And here's why. The very popular scenario for a long time was that the US dollar was paying great interest. For those of you guys who are a little bit older who maybe can remember this, remember when bonds in the US and interest rates were much, much higher, and the percentage that it would yield was a lot higher as well. There was like 5% and even above at times that the US dollar was paying out and that the Fed was offering. Now, the reason that that was impactful was because their counterpart in this currency cross, the JPY, offered negative rates, I believe. I'm trying to remember off the top of my head. I studied this. I wasn't actually trading during this time. But the JPY, or the Japanese yen, was offering much less in terms of interest. In fact, I believe it was negative. And we're going to use this example to understand what the carry trade is. And then once we understand what it is, we're going to talk about how you can actually trade it. Again, it's a concept that I still use today. I love the carry trade. It's a very, very interesting strategy that can yield some nice additional gains on your trading account if you know what to do with it and you do it correctly. So let's clear the screen. We'll talk about UJ, okay? USD JPY was offering, again, the US dollar was offering positive interest. So what that means is that if you were holding the US dollar overnight, basically you would collect payments. Now, the way it works, the best I can explain it, I'll probably still butcher it, is banks at the end of each day, they kind of pay out or deduct interest from the money held. So if you have your money stored in the US dollar and it's paying out positive interest, you collect a small amount of interest on that money. This is kind of like how, when you're in the US or wherever country you are, if you hold money in a bank, right, you're going to be paid a positive amount of money. Hopefully, unfortunately, in some other parts of the world, like Europe and Japan, during certain times, it actually costs you money to keep money in the bank, which is kind of weird, but it's just the world we live in, I guess. It's kind of an influence to put money elsewhere. When you decrease interest rates, it's a stimulus to the economy because people say, oh, well, I don't want to keep my money in the bank. I want to go put it in other places that aren't going to lose value. Anyways, the US dollar was paying a very positive interest rate. Okay, so it was paying you to hold your money in the US dollar, and it was costing you money to hold it in the Japanese yen. So to put your money in Japanese yens and hold on to that was losing value. And so this creates a divide. And so what ends up happening is people tend to want to put their money over here. Why? Because why would you hold it somewhere where it's just going to lose value? Wouldn't you want to hold it in something that's gaining value just inherently? Well, you're talking about really big time investors, talking about people who have billions of dollars to move around, banks and institutions, or even companies, right, that want to store their money in a place that's going to at least net them something, even kind of passively. They don't want it to cost them money to store their money in some sort of currency that's costing them, right? So negative interest rates are of no interest for holding your money in terms of that. So with that said, when you're talking about the carry trade, we're talking about capitalizing on these differences or this uneven kind of imbalances between two major currencies. Okay, and so when you have, let's just do an example. I'm not sure that this is right, but we'll just say that this is right. Let's say that the US dollar is offering 5% interest rate or 5% per year on your money, and the Japanese yen at the time is offering negative 1%. Well, what's the difference between these two numbers really quick? Well, it's 6, right? Because negative 1 to 5, that's a 6% difference in the money there. So what this means is that if you held your money, if you took Japanese yens, let's say that you have Japanese yens and you sold them, you got rid of them, and you used that money to go buy US dollars instead. I know it's kind of weird because we're talking about currency to buy currency, but bear with me. The idea is that if you put your money in the US dollar instead, if you got rid of the Japanese yen, sold off your Japanese yens, and you took that same money, right? Think of it, I think in my head that these are two banks. So if we have two banks, right? This is the Japanese yen, JPY, and then you have over here the US dollar. I like to visualize this. You guys might not get the same value, but I like the idea of saying, okay, well, I have money over here, but I don't want to store it here because I'm collecting negative interest. So instead, I want to take that money and I want to bring it all the way, a little squiggly in there, all the way over here to the US dollar instead, because it's paying positive swaps or positive interest, right? So I want to collect that. So this causes some interesting stuff to happen in the markets. We're going to talk about how to trade it in just a moment, but generally what this means is that I want to be buying the positive interest rate currency and selling off the non-positive one or the negative one even, right? Now you could do this if we are actually to switch this up and say, well, this is positive 1%, just as an example. It still could theoretically yield a positive return because there's still a spread of 4%, which means that if you took that money, you put it over in the US dollar instead, you're going to collect 4% per year. You're taking the difference between these two numbers. Now that might not sound like a lot, but when you actually apply leverage like we use in currency trading, this can actually be magnified, because when you're trading with leverage, it magnifies whatever you're doing, right? But it also increases the amount of currency that you are actually exchanging. And so this difference can be actually kind of significant when we are placing trades, because I don't know if you've ever seen those swap payments or deductions from your account that you might see when holding a position overnight. If you're a swing trader, then you almost certainly have seen this on your broker. If you're holding a position overnight, it costs or credits you the swap amount, okay? So in this case, if we were shorting the US dollar against the yen, it would cost us money, right? Because what that would mean is we're going the opposite direction. We're selling our US dollars, saying, oh, we don't want that, a little squiggly. We're gonna go buy the Japanese yen, and that pays a less. So we owe that amount to the US dollar, or we're losing that amount, and instead only collecting 1%. So we're missing out on that gain over here on the 5%. So generally, the carry trade doesn't want to do that. We don't want to go the opposite way. We want to go with the more positive interest rate to collect a positive swap, okay? So that's the big idea. That's the basic concept of the carry trade. Now let's talk about some ways that you can actually trade it. So let me clear the screen. And I'm going to talk to you guys about how I like to trade the carry trade. But before I do, let me show you guys something. So this is the A1 Trading dashboard. If you go to our website, a1trading.com, and then you go to software, A1 Trading dashboard, and click right here, it's going to show you this dashboard that I built and I've been using recently. So here is something that I put on here specifically for this concept, okay? This is interest rates around the world at your disposal so that you can actually see them. So remember all those theoretical numbers we talked about just a moment ago? Well, here's the actual numbers that we can use to make some decisions upon. Okay, so we've got Canada, of course, Europe. We've got all sorts of different currencies, the US, United Kingdom, Japan, and you can see all the various interest rates. Now, in the climate that we are currently in right now, interest rates are very down. You probably, unless you've been living under a rock, you know that 2020 has been crazy. We've had a lot of market corrections. We've seen lots of fear in the markets. And if you're watching this like 4 years from now, comment. That'd be really, really cool, because I don't know where I'm going to be. But comment and let me know, is the climate different? I'm sure it probably is, but we'll see. Could be a crazy decade. Either ways, we see the current interest rates. Most of them are very low. However, there are still some opportunities here. For example, a couple that stand out are not necessarily the main ones. Right now, Europe is paying 0, Japan is negative 0.1, UK is paying 0.1, US 0.25, Switzerland is actually paying negative 0.75. This is interesting because when we see a big negative like that, negative 0.75, that could be our currency that we are more willing to sell or short. Okay, this is actually also called the funding currency. So if we go back to our UJ example for a second, let me just clarify, I forgot to say, the JPY is our funding currency. And the US dollar is, there's another term for it, I can't think of it off the top of my head, but it's the one that we want to, so we take money out of this, we fund it with this amount, and we go put it in this amount. So with that said, this is an easy way to find out all the different ones that are out there, okay? So with that, we can go look at some real examples. Here's the Mexican peso right now paying 4.25%, okay? If we were to, for sake of example, short the Swiss franc and go buy the Mexican peso, I don't even know if that's a currency pair available to trade, but just as an example, there would be a pretty decent split there and probably a nice payout in terms of the carry trade. Okay, another one that I am currently doing as we speak right now, I literally have a trade open. I've got USD Zar short, okay? And that gives me the US, I'm shorting the US dollar, which pays 0.25. Right? And then the Zar, is it on here? I'm looking for it. There it is. The Zar pays 3.5%. Okay? There's a big spread there, or at least some spread, and it's paying out a nice positive interest rate because I'm selling this and buying this. Okay? So I'm short on that currency pair and collecting a positive swap each day for holding that short. Now, it's not a massive amount. I'm not making huge bank just by holding this position, but it's an additional payout and it's not a negative payout, right? It's not costing me to hold this pair. In fact, it's actually rewarding me for holding this pair short. I like that a lot because I think that's really, it's a cool extra feature. Why not look for those opportunities? So let's actually, now that we understand the currency or the carry trade, let's go back to the screen here and let's talk about ways to trade it. Now, the big thing here is I'm still going to trade all the same ways that I would trade other things. The carry trade is not necessarily an entry and exit strategy. Just because a currency pair is offering a positive interest rate more so than the funding currency pair, right, or currency, does not necessarily mean we want to just take that trade just because. However, the first tip here is going to be, generally speaking, I still want to use all of my usual technicals and usual entry methods, okay? I still want to use my standard entry methods to take trades. I don't want to abandon those or forget them. I want those to still be the core reason behind an entry into my strategy. However, I will be taking trades in the direction, if I'm trying to capitalize on the carry trade, only in the direction of the positive yielding situation or the positive currency pair direction, okay? That's key in obviously collecting the swaps that the carry trade offers, okay? So we're keeping to our standard technicals. We are trading in the direction of the positive interest rate swaps. And is there anything else here? Generally speaking, I'm going to ride it in trends for the most part. So I don't want to just be taking a position, and this kind of falls under the technicals as well. I want to be taking positions that go with good technical setups, but I really do like to ride trends in the market that I'm going with, because I think that, you know, when the wind is in your sails and the swap is in your sails as well, it can be great. Now, here's the reason that I also say this as an important factor. Well, when you get this situation where the carry trade is well known by big institutions and lots of traders are taking advantage of this, you have to be careful that the carry trade doesn't unwind. And that brings me to perhaps the next part, is watch out for the carry trade unwinding, okay? Why did I put a W first? Unwinding, okay? The reason that this is interesting is that sometimes when we get those big interest rate changes, the carry trade unwinds. And what I'm going to do here is if we could pop up a picture of the Euro USD on the daily chart this year, check this out. Notice how in 2020 and 2019, let's see 2019 and 2020. 2019, the market was headed down. This was because the carry trade was live and strong to the downside, okay? People were selling this because if you sold the euro and bought the US dollar, you would get paid a positive swap. However, in 2020, the US dollar dropped its interest significantly and kind of killed the carry trade, or did some unwinding, okay? And this is where things get interesting, because unwinding is basically when the carry trade no longer exists and the market reverses very, very hard. And so you have to be aware of this. You have to be careful of this and be aware that, okay, if interest rates drop, that's why the market is so responsive to those, because you have lots of carry trade people or traders who want to invest their money somewhere that they are wanting to move or get out of a currency because it's no longer paying a positive interest, so on and so forth. Okay, so be aware of that, because these can be some nasty changes in directions and can be some really, really crazy moves in the market. So you want to be aware of interest rates and things that are coming up in the news about interest rates in the currencies that you will be trying to take advantage of the carry trade in. Now, to make this video a little bit more everlasting or long term, you want to come back to or look to check on the interest rates around the world, because they will change. I can actually guarantee at some point or another, these currency rates will change, these interest rates will change. So the currency pairs that are best for this are going to change as well. The US dollar versus the Swiss franc was one that I really liked buying it, because the Swiss franc pays a negative swap, right? Or negative interest. So there's that spread that can make you money, because if you're buying the US dollar collecting 0.25 and selling the Swiss franc for negative 0.75, there's some profit to be made there, right? But this is going to change. Things are going to adjust. Currency interest rates will change, and that's where you have to go look up these and try it out on a demo account. See for yourself what those swap rates look like and how it affects your account. And happy trading. I hope you enjoy this concept. I hope you enjoyed this video. If you did, please share it with a friend, subscribe to the YouTube channel, and give this video a thumbs up. It really does help me out to grow my channel here on YouTube. I hope you have a great rest of your day, and we'll see you back in the next video.